I'm going to re-emphasize the same concept, which is the strategy that I use is basically called dip buying. So the old saying, buy low, sell high, that's basically what I'm doing. So I take two concepts and I create a strategy based on that. So the first concept is, simply put, what a gap up is really simple. So on the right here, I have a software called Trade Ideas. And on Trade Ideas, you can create alerts for a billion different criteria. So I keep it simple. All I'm looking for are stocks that are gapping up. What does gapping up mean? Here's a perfect example. Here's BLNK. What does gap up mean? It shows here that it was gapping up. Actually, it was gapping up 51%. So if you notice, each of these candles represents 5 minutes. These candles, if you look at the time towards, this is where it shows the time. You can kind of see 1550. So this is basically 4 o'clock on Friday. So this is basically the end of the day on Friday. It closed, and this is the price on the right side. You can see the prices here. So look at my mouse here. You can see on Friday, the stock closed at around $4. And look what happened this morning. This candle is the first candle of this morning. It opened up at $5, around $5.90. So if you notice, there's a gap here. That's literally what a gap up means. That something happened between Friday close of day and Monday morning, this morning. Something happened in the news. There was some good news on the stock. Usually. Sometimes it's random. There's just some technical reason, but I don't even care. I don't care what the news is. The news could be an earnings report, some type of merger, some type of contract. It doesn't matter. I don't care. All I care about is that the stock has gapped up a substantial amount, and so I, like millions of other people around the world, are watching these gap up stocks. So here's a list of all the stocks that gapped up. And the reason that I have two different versions is these are basically all stocks from $10 and up that gapped. $10 and up, $10 to $1 million, whatever. Any stock that gapped up. These four, these are stocks between, I think I have it set between $2. I have a set of criteria between $2 and $10. And also that are what's called low float stocks. Low float stocks, all that low float stocks means there's not many shares available in the market. So there's less supply. So what happens when there's less supply and more demand? That's going to basically allow the stock to shoot up or down. So these stocks tend to make bigger moves. And that's why whenever you see like stocks that move up like 100% or 200%, and you're like, what the hell did that happen? Those are low float stocks 99% of the time. So every single day, low float stock are making insane moves. And so all we're looking to do, or all I'm looking to do, is not get the 200% move, because you're never going to get it perfect. All I'm looking to do is just get a chunk of that 200% move. So here's the perfect example. So again, I'm not sure which video you're going to watch first, but I'll show you how simple it is. So it's basically called like a wave theory, or like I said, dip buying. So stocks move in waves. Right? So I don't care about this. I'm waiting for the stock to dip. Once it curls back up, I'm looking to get back in. I'm looking to get in, I'm sorry. Stock goes up, I don't care about this. I'm looking to get in here on the dip up. And so perfect example is this. So obviously it's not a complete straight line, but the concept is still the same. The stock went up, it dropped down, and it curled back up. You can see the curl here. So I'm looking to get in above this candle. And look, sure enough, everybody else is watching the same exact strategy. Obviously I'm not the only one using this. So as it started to curl back up, it shot up. So it went from $5.64 to $6.51. So that was almost $1 move. I mean, you would have made a ton of money. And then here's another one. Once it went up, it curled back down, dip, 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 and then it went back up. So you could have bought in once the dip started, or sorry, once the curl up started, could have bought in here, 592, and it went up to a high of 674. So these literally are repetitive patterns. Sometimes they're shorter, like this one. This one was 5, 10, 15, 20 minutes. This one took a little bit longer, but all you're doing is you're watching for the same freaking strategy over and over again. And so that's one example. It happened again on Pola. This one was a smaller one. So again, each candle. So here's the last candle from Friday. So it was around $1.40. This morning it opened up at $2.05. So from $1.40 to $2, that's what, 60 cents for a stock that's $2? That's a huge move. So again, you can see the red candle means obviously it went down. So it dipped down and it curled up. So this all happened in 10 to 15 minutes. So you buy once it gets higher than this candle. So you could have bought here at $1.95 and it went up to $3.06. Again, you're not perfect. No one's ever perfect to get the entire move, but as long as you get a chunk of it. So there you go. So there's a dip buy, and there's actually another one. So it went up, sure enough, it dipped, went down, and it curled back up. And then look at the volume. So these are volume bars. As it curled back up, look how many people got in. See how this green bar is higher than this one? Everybody was watching the same exact thing. And then after about 10:30, it stops working. So as you can see, it dipped again and it tried to do it again, but it failed. Why did it fail? Most likely because it's later in the day, and most people stop trading at around 10 to 10:30. So that's why I don't trade after 10:30, because the dip trades don't really work anymore. So there's another example. See, this one is a perfect example of one that did not work. It literally gapped up. So here you can see on Friday it was about $6. It went all the way up to $16, which is a huge move. But there was never an opportunity to buy the curl up. It never curled up. It just dropped. You could have technically, there's a curl here, but at this point, I mean, it dropped way too much. I'm not looking for stocks. If a stock is, to keep it really simple, if a stock is too low, below this purple line, which is called the VWAP, I'm not looking to get in. The VWAP is kind of like a magnet that stocks tend to pull back towards, but if it's too far from it, I tend to stay away from those. So this would have been a no-go. I would have never got in this. I'll give you another example, and then I'll show you my strategy for risk. So here's another perfect example. Here we go on Friday, $14.60. It gapped up today to around $17.50. So again, you can clearly see it dipped and then curled. So you get in above the curl, and sure enough, it actually went above the purple line too, which is even a better sign. Went up. So let's say you buy it in $17.40, $17.50. You sell it $18.60. That's over $1 move. That's awesome. And then it did it again. It went down, dipped, and then it started to curl back up. Went up, dipped again, curl back up, went up, dipped again. I mean, this was like an awesome kind of all these waves. And again, no one's ever going to be perfect. You're not going to be 100% of the time. And so that's why it's super important to set a risk. So what do I mean by a risk? So let's take probably the clearest example today, BLNK. So this is super important that traders, this is why 90% of traders lose, because nobody wants to admit that they could be wrong. So if I'm looking to get in here on this curl, so when I bought right here at around $5.60, which was a great entry, because again, look at that curl, you have to make sure you set yourself a stop, just in case you're wrong, because again, I'm never 100% right. You're asking me if I've had losing days. Of course I have losing days. I'm not going to lie to you and say every day is a green day. That's complete bullshit. So if I'm wrong, I'm going to set a stop below this candle. So the low of this candle was around 542. So I'm going to set a stop around 540. So just in case the dip buy doesn't work and it continues lower, I'm out at 542. So I always set myself up with a stop. So let's say worst case scenario, I get it. Now there was no entry here because this candle, it never got above. The dip would have been if it curled up. It never curled up. It started to level out. It started to curl, but it never really did it. Well, let's just say I was super aggressive and I wanted to buy in here at 13.27 right here. And I'm like, this is going to go up to back to $16. I'm going to make a shit ton of money. And let's say I don't set a stop. I say, you know what? I'm 100% in on this. I don't think it's going to go bad. If I got in at $13 and it freaking dropped back to $9, I would have lost on 1,000 shares. I would have lost $4,000. So you got to make sure you're setting a stop. Now instead, if you set a stop at, let's say, the low of this candle, 12.20, so rather than lose $4,000, you would lose, let's see, from 13.20 to 12, so you lose like a grand. Now I'm talking about if you buy 1,000 shares. Obviously, you don't have to buy 1,000 shares. You can buy 100 shares. No one, everybody's going to start off at a different price point, different buying power. As long as you are consistent with your risk management, that you're willing to cut your losses, you're willing to defend your capital. That's the most important. So I hope that helps you out understanding, these what gapping is, gap ups. So all these stocks gapped up today, and all these stocks were being watched by millions of people around the world. And dip buying is what I do. So I hope that helps you out. Let me know if you have any questions.